Today, I have Dr. Mukesh Jindal, co-founder of Alpha Capital, on our platform with us to discuss about three quite popular strategies, which is SIP, SWT, and STP. Thank you so much for joining us today, Dr. Jindal.
Thank you, Neha. It's a pleasure to be here.
Okay, so let's simplify for the audience first. What exactly is SIP, STP, and SWP?
So, Neha, I think these SIP, STP, SWP are three strategies which are the biggest blessings for investors, for investments, for wealth creation, for wealth managers like us. We
Right,
use it, so much every day, and it makes our job very easy. Of course, they stand for systematic investment plan, which is SIP. STP stands for systematic transfer plan, and SWP stands for systematic withdrawal plan. But I
right.
don't just want to give you technical jargons, and it's very important that we understand what do they really do. And the best way to explain them is through a story. So, can I share an interesting story if you allow me?
Sure, please go ahead.
So, Neha, what is happening is, India is technically a conservative society. When I say conservative society, we majorly invest in safe investments, like fixed
Right,
deposit, post office schemes, PPF. If you look at the numbers, India this year became the most populated country with 140 crores of population. And
right.
if you look at the number of PEN card numbers which we have in India, that is around 44 crores. And out of
Hmm.
44 crore PEN numbers, only 3.4 crores have invested in mutual funds, and which
Okay.
is, almost 8.5% of all the PEN card holders. And out of 140 crores, we can say only 2.5% have ever invested in equity markets through mutual funds. And this number in US is around 47%. So what I'm trying to convey
Hmm.
is that, the Indian market, people believe in safe investments, but
Right.
it comes at a cost, because when you invest in safe investments, you get a return of, let's say, 6, 7, 8%. And with inflation being so high, the government may report a 6% inflation, but experienced inflation is even 8, 9%. So when the inflation is so high, investors want higher return. So how do they do that?
Absolutely.
How to get the higher return? Because returns, there are no free lunches. For every extra return, there is a risk. And the
Right.
story is about how do we manage the risk. So at the first level, investors understood the importance of equity, and that equity
Right.
is a tool which leads to wealth creation. And if you talk about Sensex started in 1979 at 100, today it is 62,000. It has grown 620 times, given 16% CAGR. So people understand the investment in equity. So they want to
Right.
do that. Now, the first level, the second level problem which came in for the investors is how to invest in equity, which stocks to
Hmm.
pick, which sectors to pick. And that's where the mutual funds came in. They said, okay, we are the experts. You give the money to us, we will invest in your behalf. Fantastic. So people love this concept, and people said, okay, we'll invest in mutual funds. The third level challenge which came is when to invest,
Right.
because markets are volatile. Sometimes it's high, and there are emotional biases, because typically, we see that investors invest in money when market goes up, and they sell when market goes down, where they should be doing the reverse, and which
Yeah.
leads to investor earning lower return. And in fact, there was a Morningstar study which said that if equities give 15% return, normal investors earn only 8, 9%, because they invest at the
Right.
wrong time. And that's where these strategies of SIP, STP, and SWP comes in. They,
Right.
make the journey of investment and withdrawal from the stock market very smooth. If you look at a common word in the three terms, SIP, STP, and SWP, it's systematic. If you
Systematic.
do a
Yeah.
Google, I was doing a Google on the word systematic. Systematic means more organized, more
Right.
disciplined, more methodical, and anything which is discipline, makes it easier. So I think these are three fantastic blessings. And, at Alpha Capital, we almost advise on 4,000 crore of asset. And trust me, we use it, SIP, STP, SWP, for our clients day in, day out. And without this, our job would have been very tough.
Absolutely. I also want to dig a little deeper when it comes to all these. Um, Sorry, just a second. Yeah, having some issue. Yeah. Yeah, I want to dig a little deeper when it comes to these three strategies as well. Can you explain the mechanism of these three strategies and how exactly they work? And specifically, if we consider the durations of these strategies.
Sure. So let's take one strategy at a time. Let's start with SIP, which stands for Systematic Investment Plan. Okay.
Right.
And systematic investment plan comes for someone who has a regular income. Uh, Classic example will be someone working in a job. Let's say he gets 50,000 rupees on a monthly basis and he wants to invest 10,000 rupees on a monthly basis. So under SIP, you give a mandate to a fund house, mutual fund house. And normally these SIP, STP, SWP can be run on any existing mutual funds. They are not separate mutual funds. They are strategies
Right.
and they are run on top of existing funds. So first level is you identify the fund, and if you have to plan, okay, I have to invest, and you decide I don't want to invest lump sum because market timing becomes difficult. So you say I'll do SIP, and from under
Right.
SIP, what happens every month, a money will be deducted from your bank account and will be invested in the scheme which you have shortlisted. Now what
Right.
happens is that the frequency which you can opt for under SIP, you can do it daily, you can do it weekly, you can do it monthly, you can even do quarterly, and the money keeps going it accordingly. And minimum transactions which you need to do is 6 transactions. And the advantage of SIP or STP or SWP is that you can start them, stop them anytime. So they're very flexible. It's not like an insurance product where the commitment is fixed. It's flexible. So tomorrow you want to increase the amount or reduce the amount, it can be done. So technically, SIP gets done when you have a money coming in your bank account regularly and you want money
Right.
to go from your bank account regularly. So that's where the SIP comes in. Now, second comes the STP, which is Systematic Transfer Plan. Now, let's say you have a lump sum amount which you want to invest, and you don't want to invest the lump sum amount directly in the markets or any mutual
Mhm.
fund, and you also don't want money to be lying idle in the, let's say, bank account. So what you do
Right.
is you park the money in something called debt mutual funds or a fixed income mutual fund, which are safe, and where you get an interest of 6-7% on. And from there you give a mandate to the fund house that every month you transfer money into equity at a fixed interval. The interval could be daily, weekly, monthly, quarterly, which we discussed, and it can
Right.
run for 6 months, 1 year, 3 year, 5 year, whatever time horizon you select. And what you are doing is, when you transfer money from, let's say, one scheme to another scheme, maybe from a safe scheme to aggressive scheme, you're trying to reduce your market timing. You keep buying every month, and the repeat cost averaging comes in. Sometimes you buy units expensive, some you buy units cheaper, so it gets averaged out. So it plays a
Right.
very important role, when you want to transfer scheme from one to other, from a safe to risky. It can also be done vice versa. Let's say, when markets are going up, you want to book profit. You don't
Right.
know and what is the right time. So you say, okay, every week I'll, transfer the money to my safe fund. So that's where the systematic transfer plan or the STP comes in. The third is the systematic withdrawal plan or the SWP. Now, let's say you build up a good corpus, and after disciplined investments, you have good money in the mutual fund, and you got into retirement, or you want a regular income from your fund. And one option
Right.
is, of course, you redeem the money, and you look at the market and you redeem, and which becomes very difficult, because you don't want to be in a situation that you redeem and then market goes up. So what you
Right.
technically do is you tell the fund house that from this particular scheme which you've identified, systematically sell the units and transfer the money to my bank account. So you may say, okay, let's say in
Mhm.
a fund you have 5 lakhs, you can tell, okay, maybe 10,000 every month you sell from that fund and transfer to my bank account. So this way you can plan your withdrawals. So
Right.
it makes our life very easy. So SIP is how you invest, from your bank to the funds, and STPs from one fund, how do you transfer, and SWPs, how you withdraw. So these are strategies which makes our life simple.
Definitely. So, for our next question, I want to take a specific example when it comes to all these three strategies so that we can understand this in more depth.
Sure. Let me try to explain you with example. So where does a SIP comes in? Simple example will be, let's say someone has taken up a job, and he or she is earning 50,000 a month, and
Right.
now he plans that there is a 10,000 of savings which she or he, the investor, is generating, and the money should be invested on a monthly basis. Now, one option is that the investor can, do on their own. Every month they visit the market and they do the buying, or whenever they think the market is down. But as I told, there are biases. India
Yeah.
is becoming more focused on consumerism. We end up spending a lot more than we
More.
earn. That's why you have so many fintech apps, lending you money. For every spend
Definitely.
you have, spend now, buy, pay later kind of schemes. So one thing what SIP does for this young investor is it brings the discipline. It's a forced investment. And that's what Warren
Right.
Buffett also says, that when you have to invest, don't try to save and then invest. So if you're getting, let's say,
Hmm.
50,000 rupees, first invest the money, what you think is
Yeah.
good, and then spend. So it's a forced
Right.
discipline. So let's say this young person earning 50,000 can, opt for this SIP plan. He can say that 10,000 from the bank account goes every month to a scheme. The beauty of this plan, Neha, is that, when 10,000 goes on a monthly basis, it may not look a very large amount. But when an investor looks at the portfolio after 2 year, 3 year, 5 years, it suddenly becomes a very large amount, and it
Yeah.
doesn't hurts. And so this is one advantage. It handles the biasness of discipline of investments. Second is trying to reduce the market timing, because you don't have to worry about the market. You just forget about the market. If someone doing a
Right.
SIP, you don't have to really bother, just opt it, and you are ensured that you will make good returns. In fact, there was, I'll share with you an interesting study by Crystal, which was done, that the probability of loss when you do SIP in 1 year is 30%, and but the same loss, the probability of loss in 5 years falls to 2%, and in 10 years it becomes zero. And so the probability of loss keeps falling. You can close your eyes and do that. And in fact, the study also said that the probability of getting at least 10% per annum return is almost
Hmm.
86%. So SIP for a young investor is very good. Now, coming to systematic transfer plan. So systematic transfer plan will be someone who is senior in the corporate structure. Okay, let's say
Right.
someone in CEO, or let's say director level, or anyone who, let's say, you got, let's say, a lump sum bonus. Let's say you got 25 lakhs of bonus, and
Hmm.
now you think about what to do. Should you be doing investment now? And what if you invest now and market tanked? Let's say what happened in COVID time. If you would have
Right.
invested in Feb 2020, then suddenly in a month you would have seen, your portfolio down
Everything going down.
30%, and you
Yeah.
don't want surprises in your life. So that's where the systematic transfer comes in. So what you do is, let's say you've identified an index fund of, let's say, UTI,
Hmm.
just for an example, for reference purpose, which will invest in top 30 companies, Sensex, top 50 companies of Nifty. So what you do is you park your 25 lakhs in a debt fund of UTI, and you give the instruction to the fund house to deploy the money. Let's say 25 lakhs you can deploy. You feel 10 months is a good time. So 2.5 lakhs on a
Right.
monthly basis, it gets deployed. So, some months it will
Hmm.
buy units when markets are down, it will get more units. Sometimes it will be high. So it gets averaged out. So you don't have to
Right.
worry it. So whenever there's a lump sum amount coming in, you don't do SIP, because you also don't want to leave the money in the bank account because it earns less, and then you have all the scams happening in the banking account. So it's
Right.
better to park somewhere and add higher return. So it's someone for you as you grow, as you have lump sum money. Now, the third is the systematic withdrawal plan, and which is very important, because the whole of the world these days is focusing on to make money, do SIP, and we had March SIP numbers. We had
Yeah.
14,276 crores of SIP in March 2023. Phenomenal numbers, and the SIP popularity is going up. And 7 years back, this number was 3,000 crores. Just imagine March 2016, we're talking about
Yeah.
3,000 crore of monthly SIP. It has gone up, phenomenally, almost 5 times. So
Yeah,
everyone focuses on building wealth. Now the bigger challenge is we need to withdraw. And so that's where the
definitely.
systematic withdrawal plan comes in. So you build up a corpus, you say, okay, let's say you have got 100 lakhs or 1 crore in the portfolio, and you feel, no, I want, let's say, 5 lakhs from this per annum. So you say, okay, I want to withdraw 40,000 approximately. So you give a instruction to that particular fund house that, okay, redeem 40,000 from that fund and credit in my bank account. So what happens
Right.
is you get your regular income. You can plan, it's like a pension plan, and it's like a
Mm.
tap. So you open the tap, you need 40,000 and you spend. Tomorrow you feel, no, the expenses are higher. You want 80,000. You make the tap a little bit, the flow increases, or you can reduce the tap. So the money flows and you can plan your regular expenses from that. And what is also important, Neha, in this whole thing is, like we manage so many assets. One big challenge which we see is people don't withdraw money.
Yeah,
So people withdraw with a plan that, in retirement they will spend so much, but we Indians don't spend.
yeah,
And so that's where this
exactly.
forced withdrawal comes in. And so we use this technique with a lot of our clients. We say that, okay, I'm going to start the systematic withdrawal plan. The money is going to come in your account. Doesn't matter whether you
Mm.
spend or not. Maybe when you see the money in your bank account, you will spend. So it's like a
Right.
forced withdrawal, forced spending also. In retired people, it's very important that we force them to spend. Maybe with your parents, you must be experiencing it. They don't spend, and maybe
Yeah.
so that's where these strategies comes in.
Definitely. And I think it's a conditioning that a lot of Indian parents and Indian grandparents have like passed on to the generations where they are forced, they have this mindset where they don't want to spend, they want to keep it for some future event that may or may not even come. So I think spending, whenever spending increases, it is actually better for you because demand supply balance happens. So,
Absolutely.
specifically when it comes to investments. So, next question is basically about it's the most simple question, but I think it's one of the toughest also. Which one is better out of these three strategies?
So no questions are simple. We all have been taught, and I think again this is it's a simple question, but a very important question because a lot of time we have the options, and we don't know when to use them. So answering your
Right,
question, which is better, I think all three of them are better, and it depends on the stage of your life you are. It depends on the goal you are looking for. It depends on the market conditions. So one, it's
right,
very important that investor has a knowledge about what these strategies are, and these are flexible strategies which can be run on any funds. There is no extra cost which a fund houses charges on this. They can be tweaked, increased, decreased, stopped, act as per your convenience. So these are the
mm,
powers which you have. So sometimes what happens, it's like you're going in a war and you have the weapons, and so, you don't realize that you have so many weapons and how to use them. And so
right.
knowing that which weapon should be used at what time is very important. So as we discussed, SIP is someone for someone is getting a regular income.
Right.
SIP doesn't make sense for someone who is retired. I'll be surprised if, a lot of time investors, retired people get sold SIP. There's no point, right? When
Yeah,
they don't have a regular income. So if you have a regular income, do SIP. If you have a lump sum money coming in, do systematic transfer plan. And or STPs can also be used. Let's say there's a goal. Let's say you plan to buy a car. Let's say you plan to buy a BMW car 1 year down the
right.
line, and you have to withdraw the money from the market. Now you don't know whether you should withdraw the money at that point of time from the stock market, or you should do now, because what if market crashes then? You withdraw now and
Mm,
market crashes then, or maybe you don't withdraw, you withdraw now and market rallies from here. So what you can do a systematic transfer plan from an equity fund to a debt fund in next 12 months. So depending on the
right.
goals, and when of course you need a regular income, then SWP comes in. I think what is important is knowledge is the power, the learning is the power. The more you're aware, and I think the better you will be able to use it. You will have your own intuition what to use it.
Definitely. Next, I want to know some benefits of all these three strategies as well when it comes to investments.
See, the biggest benefit is of peace of mind. See, investments are a
Absolutely.
hassle. You agree this or not? It sometimes doesn't gives you sound sleep. And see, I always believe anything which you do, you should never have a sleepless nights, be it in your job, in terms of relationship, in terms of money. If anything is giving a sleepless night, I think something or the other is wrong, and we should make changes. So, a
Right.
lot of time we do investments, we do stock investments, and if you have to time, if you have to worry, I think it's not the right. And what this brings, the SIP, STP, SWP, the systematic strategies, they bring peace of mind. You don't have to worry about market timing. You don't have to worry what's happening today, what's happening tomorrow. You can close your eyes. Let's say if someone is doing SIP for 10 years, 15 years, when the career is going, he can be 99.9% assured that he will end up doing a good job of himself. And
Right.
similarly, if you depend on SWP, and he's going to do a good job of getting a regular pension. So what is more important is knowing about them, and how to use it. So I think one biggest benefit is the peace of mind. Second is it brings a forced discipline. And
Right.
if you realize the India saving percentage that continues to come down, and with the younger generation which lives in the moment, I think these
Hmm.
strategies becomes more important for them.
Yeah.
When you are early in the career, you don't want to be spending everything. If you need a forced investment kind of instrument, then it brings a lot of that advantage, that the
Yeah.
money keeps deducting and gradually it gets building up. So that's a big advantage. So peace of mind, forced saving, and taking away human biases, the greed and fear. Like markets are running up in the last few days, and more investors are participating now, or even if they don't participate now, they will come when the Sensex hits 90,000, and that's where they
Yeah.
will end up making losses. So discipline, rupee cost averaging, and I think simplicity is also something which is very important. It keeps the whole investment simple. You don't have to know about stocks, you don't have to know about jargons, you don't have to know about P ratio. Just select a good scheme or an index fund, do SIP, SWP, are sorted for life.
Absolutely. So, lastly, I want to talk about taxation related to these three strategies. So, how are these three taxed?
So what happens, Neha, in India, the mutual fund taxation comes when you withdraw. Okay.
Right.
Anytime when you sell the units of a mutual funds, they get taxed. At the time of investments, wherever you invest, you don't have to pay tax. So if you talk about SIP, in the SIP, you are buying units. So of course, at the
Hmm.
time of buying, you don't have to pay any tax. So let's say you keep buying for 5 years. After 5 years, when you sell, there'll be a tax element. Now, the taxation will depend on the underlying asset, whether
Right.
you have been doing in an equity fund, or you're doing in a debt fund. It will also depend on the tenure of the fund. So, for example, if you've done
Hmm.
SIP in an equity fund, now equity funds after 1 year gets taxed at 10%, and before 1 year it gets taxed at 15%. So if you sell after
Hmm.
1 year, of course the taxation will be depend on that 10%. But
Right.
let's say if it's a non-equity fund, then if you sell, there'll be different taxation, and the tenure will depend. What is also important, a lot of time investors miss on, is that the time horizon rule is also dependent on each installment. It doesn't
Right.
means for your first installment. So for example, let's say if you start doing 1 lakh SIP every month for next 12 months, now it doesn't mean that when you sell after 1 year of the first installment, everything is long term. Long term
Hmm.
becomes when each installment qualifies or completes 1 year for equity fund. And so it's very
All
important that
right.
investors look at installment wise, and when they have completed 1 year, that's where the long term and short term comes in. And the taxation rule will also depend on the underlying fund. So that's for the SIP. Similarly, it's a
Right.
systematic transfer plan. In systematic transfer, there are two transactions which happens. Basically, you're transferring money from one fund to other. So whenever you transfer from this fund, you're selling. So whenever you sell these units, there'll be a tax. Now, the taxation on that fund will depend on the underlying fund, whether it's a debt or equity. If it's a debt fund, there'll be different tax rule. If it's an equity fund, there'll be different tax rule. So over here, at the time of selling of the fund, the tax will come. And when you transfer to the second scheme, there's no tax on buying. And in systematic
Right.
withdrawal, again, you're withdrawing from the already built corpus. Now the tax will come when you sell the units and will depend on the underlying fund and the tenure, for which that units have been held. But it's not complicated. It's simple. And yeah.
Okay, so before we end our live stream, I want to take one question from our audience. So we have this question by Abhinav. He's asking, can you tell me what should be correct time to withdraw one mutual fund and invest in another mutual fund if the returns are not good?
See, Abhinav, thank you for raising this question, and it's a very important question. And because last few years, last couple of years, investors have not seen good returns because markets have been flat. October
Right.
21, the Sensex was 62,000, and today also market is around 62,000. So market has not given any return. So what, Abhinav, you have to do is you have to understand that the reason behind the underperformance. Okay, and the reason could be many. One, the reason could be that the broader market has not gone up. So for example, I told like last 18 months, if the Nifty or the Sensex, the whole of the market equity is not given return, then what can your fund do about it? So you
Mm,
have to do a benchmarking of the fund. Let's say you have a fund which has given you 3% per annum. You need to look at how does the benchmark, how much your Nifty has given. Now, if the fund has given better than Nifty, then it's okay. You don't have to worry because the fund has done better than the benchmark. It's a matter of time.
yeah.
Whenever the next rally comes up, your return will improve. So understanding from the benchmark is important. That is one. Second, what happens? There could be a situation where the fund is underperforming even the benchmark. So there are a lot of funds which underperform the benchmark. So you need to understand and that why is that fund underperforming and how long that fund has been underperforming. Because see, a lot of time the fund managers take exposure in sector and stocks, which takes time to play out. It's
Mm,
and looking at a fund on a daily or a monthly or a half yearly basis really doesn't solve the purpose, because we have seen that funds which were underperforming for 6 months, 1 year, even 2 years, they suddenly start doing better when their
yeah.
strategy starts playing out. But what you
Right.
need to do, Abhinav, is maybe you need to review your portfolio on a quarterly or half yearly or 1 yearly basis, whatever you decide, or maybe monthly. So if you feel there are funds which are underperforming, now the thumb rule which you should follow for simplicity is that if the fund has been underperforming for 1 year, continuously 1 year, then stop putting fresh money. Okay, stop putting your SIP, STP, or any lump sum money. Stop any fresh investment. Put the fund in the watch list. If the fund continues to consistently underperform for 2 years, maybe that is the time when you can exit the fund and look at a fund which is more consistent and whether where it meets your objective. So that is something. And before selling, you need to be careful and prudent about the tax which you pay and the exit charges. I don't believe in that, paying exit charges, and one should only pay under extreme conditions. So watch that, you're not paying any exit charges and there are no unwanted taxes. So I think if you follow these thumb rules, and it will be fine, and don't rush to sell, and
Yeah.
give your fund manager, give your investor investment some time.
Okay. Dr. Mukesh, is it okay if we take one or two more questions?
I'm game. Bring on.
Okay. Okay. So Abhishek is asking if someone has to enter the markets now, STP makes sense, but what should be the frequency of the STP and the time horizon for the deployment of the funds in the STP strategy?
So thanks for this question, and it's a very important and tough decision, by the way. And it doesn't mean that STPs are always better off. It depends. One, when you do STPs, you also have to look at what is your current equity exposure. Okay, so for example, let me tell you. Let's say you are a let's say the person who is asked question has moderate profile. He wants to be 50% in equity and 50% in debt. I'm using moderate for simplicity.
Hmm.
Now, what he needs to look at is what is your current equity exposure. Okay,
Yeah.
let's say your current equity exposure is 0, 10, 20%, then you are highly underexposed. Now you're exposing yourself to the risk that tomorrow, if there's a market rally, then you will lose on the opportunity, right? Because your exposure is
Mm.
less. And if you decide to do a STP, then you will be deploying maybe in 6 months and 10 months time, maybe in 6 months, 10 months, market runs up. So for example, let's say we talk about March 2020, market tanked in COVID, and then suddenly there was a big rally in a couple of months. If
Yeah.
anyone missed the rally, then it would have been very difficult to catch up. So, answering that question, watch how much underexposed you are. If you're significantly underexposed, maybe you can consider doing some lump sum investments. Okay. And then you
Mm.
can build the systematic transfer. Now, how quickly you do systematic transfer into equity markets will again depend how much underexposed you are and what is your view on the market. If you feel markets are fairly valued, undervalued, then you can build the STP quickly, maybe in 3 months' time, 6 months' time. But let's say if you
Right.
feel markets are overvalued or you're not feeling confident, then maybe you can deploy in 10 months, 12 months, or 18 months. And you can do weekly also because it will get averaged out.
Right. Right. We'll take one last question, and it's by Suthirta. She's asking, while choosing an equity index fund, what should I choose? Nifty, Nifty Next 50, or NSC 500?
Thank you for asking this question. And glad index funds are becoming popular in India. And it's important that this message goes to all that, one should do more index funds in the portfolio because large cap fund managers are largely not going to, may not be able to beat the benchmark or the index. So for large cap exposure,
Right.
you need a passive like a, index fund. And for, mid and small, you need an active fund. Now, which passive fund to do, which index fund to do? See, technically, theoretically, S&P 500 or NSE 500 is always a better index. And in US
Hmm.
also, the most popular is the S&P 500 index. But in
Right.
India, we don't have too many options of S&P 500. We have one by Motilal Oswal. And again, that is expensive. They charge around
Hmm.
1% of the fund expense. And see, when you invest in index funds, the one key objective is that the expense should be less. So I don't think we have
Right.
a S&P good 500 index. What you can consider is Nifty 50 index. It should be your core. And normally you get
Hmm.
Nifty 50 index at maybe 0.15, 0.2, 0.3. These are cheaper index. So let's say if you have 100 rupee which you want to invest in index funds, maybe 65-70% can go into Nifty and 30% or maybe 25% in Nifty next 50. Why Nifty? What is also happening, Neha, is there's a lot of flows which is coming into Nifty. See, Nifty, if you look at the Provident Fund money, Employee Provident Fund is almost buying 3,000, 4,000 crore in Nifty ETF, SBI Nifty ETF every month. Now, because of the flows from Provident Fund, and let's say even wealth managers like us, and because Nifty being a popular index, Nifty is seeing a lot of flows. So what
Yeah.
happens when an index get a lot of flows? The underlying companies also get a lot of flows, and when that happens, the benchmark becomes very powerful. That Nifty index become very powerful. In fact, there was a research paper. We don't have a time. Maybe I would have maybe gone through that in US, which was published. It says that when the why the index funds are becoming difficult to beat because the flows are so strong that the underlying
Right.
companies keep getting more and more, and they keep doing well. So one big reason is that Nifty, the flows are strong. It's a bear market index. It does very well in bear market. It falls very less. Also in a bull market, it gives good rally. So yes, you can consider maybe 70% of the portfolio in Nifty and Nifty next 50 because you have 51 to 100 stocks. There's an opportunity.
Right.
And though it took a beating, last 6 months since January because of Adani. Adani companies have a huge exposure in Nifty next 50. And but
Right.
maybe it's a good time to invest now because it's cheaper and maybe Mr. Adani will issues settled and he doesn't goes down further. So yeah, you can diversify and what you can do.
Definitely. And I think these times are buy on dips strategy perfectly fine for this time. And I genuinely think that whenever the market goes down, people should invest more instead of taking out their money. And that's the way to build wealth, I think, in future. So I just want to take one last question. One of our audiences is asking that STP makes sense in case of balanced advantage funds. Does that make sense or not?
See, let's understand what is a balanced advantage fund. Balanced advantage fund is a mix of equity and debt. Or on an average,
Hmm.
they keep 50% in equity, 50% in debt. And there are different models of balanced advantage fund, but generally they change the equity allocation based on market outlook. And when market falls, they increases equity allocation. When market goes up, they reduces equity allocation, thereby booking profit when market goes up and buying when markets are down. Balance
Right.
advantage a lovely product. Now, what is important, it depends on your asset allocation. How much you want to put in
Hmm.
equity, how much you want to put in balance advantage. It's a good product. Some part of the money for moderate clients, conservative clients, it should be parked over there. And if you feel that more balance advantage funds is part of your portfolio and you want to build up on that, if you want to top up on that, then you can do systematic transfer. So what I am trying to convey, Neha, systematic transfer can be done on any schemes. There is no right or wrong for anyone or everyone. Every person is different. The requirements are different.
Right.
Someone who's very aggressive, maybe his exposure to balance advantage will be zero or nil. Maybe for conservative or medium moderate investor, the exposure will be high. So what he
Right.
need to figure out, sit and see what his risk profile is, how much allocation he wants to do in different category. If he wants to build up, then he can use STP. So whether it's a balance advantage or equity, any investor, the STP can be done.
Okay, all right, all right. Well, thank you so much for answering all the questions here on ET Markets live stream. With that, we have reached the end of our ET Markets live stream segment. Thank you so much, Dr. Mukesh Jindal, for joining us today.
Thank you, Neha, and I want to thank all the audience over here. Thanks for the time and wishing you